Hey guys, let's talk about what's happening right now in the market.
Nice. Yeah, so Derek, you know, the insight on those numbers that are how many deposits have left the banks this year in 2022?
Yeah, so from April 2022 to May 2023, over 1 trillion in money has moved from out of the banking industry into other assets. So that's why you're seeing a lot of these banks are struggling or going under. Like that's where you're seeing the issues with the Silicon Valley Bank. That's why you're seeing a lot of these banks fail, is because basically you have the situation where they thought that they were investing in safe government-backed bonds, and they were buying those things at when interest rates are super low.
Right,
And now that interest rates are higher, those bonds are pretty much worthless. They have to sell those at a loss.
right.
And because even holding on to them isn't going to do them much good. So that's what you're starting to see, is some of these banks that are selling these bonds at a loss to get rid of some of that debt, and it creates some scare in with people who have their money in that bank, right? And so they're moving their money over to other banks. They're moving their money into other things because they you basically get a bank run in that situation, right? And so you've seen a lot of you're going to see a lot of smaller banks. I think I can't remember the exact number, but it was like 179 banks are in a worse off position than Silicon Valley Bank.
Oh,
Obviously there's thousands of banks in the US, but that's a huge number. I mean, I had a good friend of mine who he had a bank out of Nevada. I won't name the bank, but he went to take his money out and his money was frozen. So he couldn't even take his money out of the bank because they were trying to keep a bank run from happening. So you see that people are getting smarter. They're looking at like, okay, well, I'm getting 0.001% or whatever on my money. What else can I do with that money that's sitting in my bank account that I can get a better return on it? And so we're seeing that huge movement, especially the wealthy. The wealthy tend to be the ones that make those moves first because they're wealthy. They have financial advisors. They have people to tell them exactly what they need to do. And so most people don't keep their money still. And I think that's one of the things, like those who the middle class and the lower class don't realize, is you don't just put your money in the bank and have it sit in savings. It doesn't do anything for you. So you've got to look at other options to where your money is actually working for you. And that's what I love about like Rich Dad, Poor Dad. He talks about that. Robert Kiyosaki talks about it. He's like, get your money working for you. And that's what the wealthy really do. And when the banks aren't providing those returns for the wealthy, then they start putting their money into other asset classes that provide a better return. And so they start looking at like, okay, well, can I get a better return in the real estate market? Can I get that in life insurance? Can I get that in sound money like gold and silver? What are my options there? I've got an accountant who's investing in oil right now because the cost of oil is so high right now. So there's definitely a lot of opportunity out there where the returns are higher. And I think you have to start, if your money's sitting in a savings account, is doing you no good. And a lot of people are getting smart about that. We're not getting taught that in school. Most of us didn't. And so as you start to like work on your financial education, you do have to start looking at, okay, well, obviously real estate, if done right and you have a good strategy in place, can yield you a good return. Sound money like your gold and silver investments can. Your life insurance policy that has some protections in place against losses can do really, really well for you. A lot of these tangible assets, a lot of people are moving the money into tangible assets. That's becoming really, really popular right now. So like things that you can hold right now,
Right.
because our money is worth nothing. I think we're at 3 cents on the dollar.
3 cents on the dollar
Three,
last I checked.
yeah,
Yeah.
And that's the scary thing. I think a lot of people don't even know what to do. So a lot of people that I know that have their money in the bank, it's like, well, where do I put it? What do I do with it? Like, what is safe and secure? How do you know? How do you know which companies,
Mhm. Well, and I think it's really important that you do your research into whatever you're going to invest in, and look at, what safety measures are in place, what types of returns are average for that industry. I think you do have to be really careful about those that make promises that are like way out there in terms of returns. I think that's the challenge with the crypto space right now is, that a lot of people has put money in the crypto space, and right now it's very volatile.
Right.
You have the SEC going after a lot of these exchanges. That's causing problems. So I think just doing your research and looking for a reputable company that has the safety measures in place, so that and I think provide some education too for you. If you
Yeah.
can get something that's going to provide you education, they're going to teach you about why that particular investment is a good investment and how that process works and how your money can work for you in that process. I think that's the kind of things that people want right now. They want to be educated on good, solid financial opportunities that have, above average returns, definitely better than a lot of what the banks are offering these days.
Right. That's a good point. You said the education. I think that's really key, because there's a lot of this, uncertainty, a lot of kind of topsy-turviness going on, and a lot of people don't really know where to turn because they're not being educated. They're just, seeing some pie in the sky or what's shining and what's all the bells, what's the shiny objects, and they're just really just kind of, following the crowd, and the crowd doesn't really understand, you know, how to position themselves, especially when it comes to these type of markets. And like you said, more people are moving towards they're moving towards hard assets. And like you said, like the wealthy, you just follow the money, follow what they're doing. Like even a couple of weeks, maybe about 30 days now, a lot of the sophisticated money, they're pulling their money off the exchange, or they're pulling their physical gold and silver off the exchanges, and they're requiring actually possession of it. They're taking delivery of it, and that's a big deal. And when you talk about things being heavily manipulated, I think people are more so concerned with like debt instruments, things that are tied to dollars. And when you think about things that are shifting, well, it's happening kind of around us, and not a lot of people are really paying attention. You know, and the date's coming like August 22nd, coming up, where Saudi Arabia is going to make a final decision on what other currencies they're going to be accepting uh, to trade in oil, to purchase oil, and that's a big deal. I mean, how many of those countries that are electing or that are applying for BRICS nations to move away from the dollar, and a lot of those countries are in something called like the Shanghai Corporation, that are on the Belt Road and Rail Initiative. These are like treaties, and these are contracts and agreements that are being made by China and Russia, and they're being made by really allies of America. Like France. France just signed a 51-point deal with China, building 5G, and also, like military engagement. And so it's just like, well, something's going on here. Like, why aren't, we have to really wake up, because when that happens, it's not going to be something that you're going to be able to see. It's just going to happen like overnight. So, sound money, things that have been, that have proven the test of time, is what people have to really at this point start aligning themselves with. It's not going anywhere. It's on our front door. And like you said, the education, having the education behind it. Why am I doing this? Well, I do like, the certain insurance contracts that really put a stop loss, that really protect the principal. I like physical gold and silver. I think physical gold and silver is a great way to go because, one, it's wealth preservation. It protects your purchasing power. And then on the flip side, there's there's an offensive strategy to gold and silver, which it gives you that growth and that income potential when it comes to that strategy when it comes to gold and silver. So I think a lot of those things, even real estate, the right type of real estate, having the right strategy in real estate, that's a big deal as well. So anything hard assets, I think that's you're gonna be okay. You're definitely gonna be all right when it comes to hard assets, especially right now and what we're seeing. So that's a big deal. That's a huge deal on having physical tangible assets. So, coming up with like, for instance, like insurance, what would you suggest that people do? What type of insurance we should grab these days? Obviously, maybe IEL may be a little risky, when it comes to because it's tied to either S&P or a different index. It could be a possible little risky. May not be fitting for some people. What are your thoughts on that?
Well, I think there's a couple options there, but I think what people don't realize is the banks utilize life insurance to preserve wealth and to build their wealth. And there's a reason why they do that is because actually, like something like an IUL policy has what's called a ceiling and a floor to it. So you can put your money into it like you would a 401k or an IRA, but allows you to pull that money out whenever you want. So a lot of people, that's where that becoming your own banker concept came from, is this idea that, well, why would I put my money in an IRA or or a 401k and I have to wait till a certain age, right, before I can even touch that money? And if I touch it before that, I get, I basically, you get fined, right?
Yeah.
You get fined for touching that money, where you can put it in something like a life insurance policy. It's growing in wealth. It has what's called a zero floor. So what that means is that if I put money into this policy, so let's say I put 10 grand into a policy, and they invest it into the S&P 500, if the S&P 500 like has a loss, let's say, the life insurance has basically a protection in place from loss. So if I put 10 grand in, I won't lose that 10 grand. Now, on the flip side, so you may get to the end of the year and you may have a 0% APR, right? However, on the flip side, it has a ceiling. So if the S&P 500 does really, really well, and the floor is well below what the S&P 500 did, you're only going to get a specific return on it, right? So on average, it does really, really well over time. Most people, they're not very good at sitting on that money, and a lot of times they're pulling it out when it goes down and they're putting it in as it goes up. And so a lot of times the average American, I think, return is like 3% or something like that. It's well below what the actual S&P 500 has done. But generally, like the IUL policy has like a 10 to 15% ceiling on it, on your money over the years. So you have that, then you have like the death benefit as well that goes with that. You can borrow against it, and that money acts as if it's still there. So if I put 10 grand in and I wanted to borrow the 10 grand, it still acts as if it's more of like a loan type scenario. So the 10 grand is still in there, growing year over year, but I've now taken out this 10 grand to buy a car, or 100 grand to buy a house. So that's where like it becomes advantageous over doing something like having your money in the bank, because you have that death benefit and you have that growth in tied to the stock market, but the safety measures in place. So there's a lot of benefits to it that you don't normally see, or that most people don't really know about, that, you know, if you find a good company that will educate you on that, and you learn more about, I like this company, they're MPI Unlimited. Curtis Ray, I know he's written a bunch of books recently, but he's really created some innovation in that market that was much needed. And he tied that around that IUL policy and shows you how to build that wealth. So I've been following him for a while, and I happen to know him personally. I got a chance to meet him and get to know him. So I think there's, you know, and he's not the only one out there, but there's a few companies out there that I think really know this strategy really well.
Yeah.
But most of the time, that what gives the life insurance industry a bad name is most people try to sell you like the largest policy they can, because most agents are looking to get the biggest commission they possibly can, and it's usually not in your best interest to get the biggest policy you can. But if you utilize it as more of an investment strategy, then generally you're going to get a policy that's much lower, but has a greater potential for wealth and helping you retire with more money in your pocket.
Do you typically have to pay those loans back, Derek?
No, you don't. You don't have to pay those loans back. I advise that you do.
Yeah.
But if you want to just borrow against it and then have, as that grows over time, once you decide to start living off of it, or once you die, then they'll pay out what's owed on there. Now the downside to that particular like life insurance,
178 Comex
now the one of the things that people don't realize, and the downside to the life insurance market is once you commit to a certain amount, if you don't pay that, so like maybe you've put in money each year, but then maybe you say, hey, I'm going to put in $20,000 this year, and you don't make it, your whole policy can get canceled and all of that money is lost. So once you make a commitment with it, you got to stick to it. And that's where people don't have, a lot of people just, that's where they struggle with, because life has its up and downs. You know, you can get laid off from your job. You know, obviously they give you a little bit of a buffer period to get caught up, but if you don't continue to commit to what you've committed each year, then you're going to have some problems with keeping that policy and having that work towards you. So you definitely have to put money into it that you can afford, that you feel like you can afford every single year towards it. But it can be a really powerful tool for helping you retire with more money.
So you gotta have double streams of income. You can't just rely on that.
Yeah.
It's just got part of the
basket.
Yeah, part of the basket.
Yeah. The whole idea of having multiple streams of income is super powerful. I mean, you look at any billionaire or any wealthy person out there, they're not generally getting wealthy off of one avenue. I mean, even the guy that owns a business, he's investing in real estate. He's got his life insurance policy. He's maybe in the S&P 500. He's probably got some crypto. You know, everybody's, you know, usually the wealthy have their money in a few different avenues.
Right.
Because they all kind of fluctuate. There's always gonna, you know, if you have one struggling, maybe you have something else doing really well. And that's kind of how that works with a lot of those investments. They go up and down over time, but they all pretty much do this, where they have like that, just that steady incline. If you look at any curve on any investments over time, they generally grow.
Please.
Now, you know, another thing, thinking about like the multiple streams, like to even protect even the policies. I think also you got, you know, you think about, you know, what happens if we continue to say the rates continue to go up. You know, banks continue to kind of really go insolvent, really. And when you look at that, like, I guess it's kind of a double whammy, you know, people see that and they continue to pull their cash out of the banks. So now the banks don't have any leverage to lend money out, because now they don't have the deposits. The deposits don't reflect on their balance sheets. And then you're talking about now they've been heavy into bonds or treasuries. And like you were saying, now with the rates going up, it's like they're worthless. And then like China and a lot of these foreign nations, they're not buying treasuries anymore. They're like dumping them. So it's almost looking at that, like who's buying them. But then you start to look at the reports. The feds are buying a lot of those bonds, and it's kind of like they're kind of dumping money into the system to kind of really, it's like fake. Well, it is fake money, but they're just kind of just overinflating the system and saying, okay, we'll buy those bonds back, but the rest of the world is seeing, well, there's no real value there. So I think the other thing, people again, they have to like have a diversified, well-balanced portfolio when it comes to especially what we're seeing. It's going to be interesting. So it's going to be really interesting to see what happens over the next couple of weeks, the next 30 days. Yeah, I think we got to brace ourselves here. We're going to have to really brace ourselves. Like you
Well,
said,
I think too, like more people are getting educated, and it's not really well known, but I think as more people start doing their research, they're going to realize that our monetary structure is built on a house of cards. I mean, it's really centralized around this idea of lending. That's why you get credit card offers in the mail, and you don't get, open a savings account offers. You're starting to see that right now. Like more people are saying, hey, I'll give you money if you open, like a lot of these banks are saying, hey, I'll give you money if you open a savings account. And that's mainly because they've over leveraged themselves. For every dollar you put in the bank, they lend out 7, and those other $6 aren't in existence. They haven't been printed. So if we all start holding on to our money and we stop getting loans or buying on credit, the whole structure comes crumbling down. And I think if the more Americans that realize that and educate themselves around that, I mean, really, like you may see that whole structure collapse, and it will at some point. It has.
Right. I think you're right. It's like the balloon is just getting bigger and bigger and bigger. It's almost like at what point, when does it pop?
Oh,
When does it pop? And you're right, Derek. Like it's like they have to print more debt to cover the debt they already printed, and it just keeps getting larger and larger and larger. And then, like you think about in real estate, well, to buy real estate, your DTI has to be, it has to be favorable, right? It has to be at 29, no more than 30%, and that's what has you right in that nice sweet spot. But like America's DTI is like way over 120%. It's like, well, how does that happen? It's like when you start up the hedge, you're like, that doesn't even make any sense here. And so then you got that, but then you throw that also in the mix, and then you throw also now you're seeing other nations move away from the dollar, and the inflation's rising because the more money you print, more inflation goes up. And they're not, before, like you look 2 years ago, they said inflation was transitory. Now they just don't really know what to say. They're trying to figure out how to even keep up with it. They're trying to figure out how to even fight it. And the only way they can fight it, they got to continue to raise interest rates. But of course, what that does, it drives the cost of the treasury market down into the dirt. And so now, like, we're kind of in this no man's land right now. So I a lot of them, even some of the senators said, well, just let the whole thing crash and reset. Let it crash and reset, and then just let, because Americans are resilient. Americans will bounce back. We are resilient, so we will bounce back. But then, of course, it pulls the veil, back and pull the curtain back, and now people get to see like the real fraud that's been going on. Even like with the like just a couple days ago, there was like over 28, I think, million tons of silk like that disappeared off the markets, and like there's over 5,000 contracts they can't fulfill. So that's a whole nother issue. What if people's like, what, I want my physical assets? Well, they can't fulfill 5,000 orders. What would that do? So now you throw that in the mix, and You know, it's a lot. It's a lot that's happening, and now you're like, okay, well, we got all this stuff going on, and they're just kicking the can down the road. Eventually, they're going to kick the can down the road so much to where the can's going to be pretty huge. You're going to break your foot trying to kick it. So, you know, yeah, it's just, you know, I don't know. And then you start to think, well, you got some of the sharpest minds on the planet, but then they're making some of the dumbest decisions.
Mhm.
Like, how is that even possible? Like, so then you start to think, okay, if they're that smart and they know what's going on, so now are they doing it on purpose? Is it
That's what I,
being done? And if it's purposely being done, now is it more for a reason for everyone to wake up and really start protecting themselves and preparing if they are doing it on purpose?
mhm, mhm. Well, that's a lot of info for us to take in. I'm sure. Well, I'm sure we'll start seeing some things happening in the next couple of weeks. So we'll stay tuned for that. And everybody subscribe to wherever the subscribe button is below. And we'll see you tomorrow. All right. See you later, guys.